Hello, my name is Brent Kessel, and I'd like to share with you my basics of asset class investing. There are four concepts that you should understand. First, markets work. Because there are tens of millions of investors, including the most sophisticated institutional managers in the world, all with very similar access to information, a stock-picking investor or mutual fund has to believe their knowledge is superior to the collective knowledge. As it happens, this assumption turns out to be correct about half the time, which is why so many people are suckered into continuing to invest with money managers, brokers, and actively managed mutual funds. Second, diversification is key to reducing risk. Paradoxically, if you combine asset classes which don't all move in lockstep with each other, you increase the rate at which your wealth grows as you decrease your risk. I call this the only free lunch in investing. Third, risk and return are related. The highest rewarding asset classes are those which, on their own, have the highest variability or risk. Finally, the asset classes you invest in determine your performance, not the stocks selected within those asset classes. So what do you do about it? There are three basic strategies for increasing investment returns. You can allocate your money into different classes of stock. You can instead try and pick individual stocks or hire a manager who picks stocks. You can also try and figure out when the market will go up and down and buy and sell accordingly. Let's look at what a variety of different investors believe. Along the top, we distinguish active investing, or stock selection, from passive investing, or asset class selection. Along the left side of this grid, we separate those who believe that it's possible to time the market from those who know that it can't be done reliably. Which of these philosophies have you and your investment managers followed? As you can see, most financial media and typical retail investors believe that stock selection and market timing work best. Most academic researchers, a sizable number of institutions, and of course Abacus, have read the research and know that passive investing without market timing is the surest way to grow wealth. Let's take a look at how active investing as a whole compares to a popular stock market benchmark. We looked at all the actively managed U.S. large-cap funds in Morningstar and compared them to the S&P 500, a U.S. large-cap stock index. You would expect that, if active investing worked, a majority of them would beat the leading index. As you can see, that's just not the case. In fact, in the past 20 years, never has a majority of actively managed funds beaten the S&P. But every year, some of them do. Why don't we just hire the winners? The problem is, how do you know in advance if your pick will beat the market? I'll give you a hint. You can't. Most people try to rely on past performance. Why not just split your money 10 ways and give it to the top 10 mutual fund managers over the past 10 years? All the experts agree that 10 years is long enough to get rid of the lucky managers and leave only those with great skill. We looked at the best funds from 1994 to 2003, and then how they did from 2004 to 2006. They had great performance. How could we go wrong? Oops. Only 4 of the 10 were able to beat the S&P 500, and then just barely. They averaged in the 60th percentile, quite a bit worse than the average fund. And their 1.6% underperformance compared to the index meant that $100,000 grew to 27% less than the same amount would have grown to invested in the index. So when any mutual fund, financial advisor, or friend is boasting about their past performance to try to get you to follow their actively managed strategy, run the other way. The most important thing in investing is to leave your emotions at the door. The average investor should always do the opposite of what feels logical or intuitive. The Gallup organization tracks an index of investor confidence. Look what happens. The average investor bought when the market was at its peak and sold when it was about to make a huge rise. This is why so many people view investing like gambling and have a hard time even matching the returns they can earn at the bank. Dalbar did a study showing that the average investor grossly underperformed the S&P 500. These are actual investors from 1986 to 2005. Someone who had invested $10,000 in the S&P 500 index at the beginning would have $94,754 after 20 years. The average investor ended up with only $21,493, less than a quarter as much money. And that's just the average. Imagine the investors at the bottom of the bell curve. Even a very basic indexing strategy is a great choice. A simple two-fund investment model came in around 55th out of 192 funds when compared to the largest professionally run corporate pension plans in the U.S. These plans hire the best and brightest investment managers and spend huge amounts of money on research in order to try and add return compared to the index. Of course, those expenses may explain some of their underperformance. But a simple index strategy is not good enough. Adding a few additional asset classes increases return dramatically and lowers risk. That's because of the premiums investors can earn by investing in small stocks and value stocks, which you can learn about in part 2 of this presentation. So why hire an advisor? An advisor will keep you disciplined in the hard times, keep your account rebalanced to its asset class targets. For more information on this, check out our piece on rebalancing. An advisor will also update your asset class targets as the world changes and act as a fiduciary with your money, treating it with more care than they do their own. And lastly, here are some great quotes about passive investing from some people a lot better known than me. Enjoy them, and if you have any questions, please call one of our advisors. Enjoy your day.